So moving on, we are in an industry where we have a lot of very high value products, not just tyres. I mean, if you look at the average depot, and you look at the tools and the equipment and various other supplies that we have on site, you can understand that that's quite a tasty proposition for the unsavouries out there. And just over the last year alone, I've had calls from members where people have gone in and cleared out entire depots overnight. And it's funny because there's a Coronation Street connection, because I remember I was sat watching Corrie with my wife, and it was when Johnny walked into his factory and the roof had gone and everything else in it had gone. And my wife said, "Oh, that would never happen, somebody would notice." I said, "Well, it's happened to a couple of our depots where people have actually gone in through the roof and taken everything, and I mean everything, that isn't bolted down, and sometimes even the stuff that's bolted down, and that's a worry." So insurance, good insurance, making sure you have the right insurance, making sure you've actually assessed the risk to your business is very, very important. So we've brought in somebody who knows a lot more about this than I do. So please welcome to the stage Mr. Ben Harrison, the Divisional Director of Jelf Beaumonts.
Thank you for the introduction, Stefan, much appreciated, and thanks for allowing me to speak at your conference today. I've brought with me Rod Watson, who works very closely with me. Insurance is very much a team sport. Rod's going to talk a little bit about how we actually manage claims through as we go through the presentation. What we've noticed is the tyre industry is a very risk-aware industry, which is why I think our services have been so well received. The aim of this presentation is to hopefully provide an overview of the services and highlight some potential exposures in areas which could really damage your balance sheet if not addressed. So if we just get the corporate bit over and done with first, and just tell you a little bit about who we are as Jelf. Jelf's an award-winning consultancy that supports businesses and individuals with insurance, employee benefits and risk management advice. In December 2015, Jelf became part of Marsh & McLennan Companies, the global leader in risk strategy and people. In January 2017, Bluefin joined Jelf by becoming part of the Marsh & McLennan Company, bringing together two leading community brokers and client advisory businesses. Together, our purpose is quite simple: to build long-lasting relationships with clients based on personal service and technical excellence. The combined business has 80 offices, servicing 251,000 clients. UK-wide, our combined turnover is 210 billion. As part of the Marsh & McLennan group of companies, we have the scale and financial strength to provide access to a broad range of market-leading products and services. MMC colleagues work on behalf of clients of all sizes in every industry and include businesses, government entities and individuals all around the world. So our culture. Jelf's objective is to develop our positive culture to support future growth. We provide an environment where our colleagues are engaged, empowered and enthusiastic about delivering an excellent existing service to our clients. Of course, size isn't everything, but we feel that by employing our services on the ground, putting in the hard yards, backed up by our analytics, because as a group we settle billions of pounds annually, we feel that we can be ahead of the curve, steering clients in the right direction, and ultimately saving them money, whilst also ensuring that they sleep easy at night. Just a bit about our commitment to the tyre industry. We talk a lot about communities in Jelf, and whilst we are extremely active in our local communities, my team in Shrewsbury consider the tyre industry to be our chosen community from that office. Our story with the industry began in the 1980s when issues arose in the products liability market. Principally, those issues surrounded retreaders being unable to obtain cover due to there being a number of poor products being produced. Casings on the side of the motorway were much more common than today, and there were problems related to goods being imported from foreign shores with little or no prospect of a recovery being made if a product failed, causing injury. Solutions were found and the client base grew quickly within the supply chain, including retreaders, recyclers, fast fit operations, wholesalers and roadside fitting to trucks. Other brokers were also using us to place risks on their behalf as they were unable to source cover themselves on the open market. I think insurers trusted us back then like they do today. In 2011, Beaumonts acquired the business in Shrewsbury. Beaumonts, prior to becoming part of Jelf in 2015, had a successful external risk manager proposition. which have been utilised in the transport and logistics sector. Realising that these sectors shared many of the same issues as the tyre industry, we adopted our model to add some value. So what I want to do today is talk a little bit about how risk and claims management can have a positive impact on the profitability of your business. We've got a proposition for our clients and prospective clients based on the principle of replicate what they would have by directly employing a risk manager. In this presentation, we will demonstrate how all the various group disciplines and systems can work and directly benefit clients and insurers on various levels. Our service demands high quality, high cost, human resources and a long-term commitment to the philosophies we have developed and continue to evolve. As you will see as we go through the work we do for our clients and insurers, our whole emphasis is on stripping out the waste and inefficiencies caused by us, whether that be through ever-improving claims management systems or preventative risk management controls. Naturally, this means that our clients and insured partners benefit financially as a direct consequence of our vigilant claims and risk management. Superior risks being transferred in, and the comfort that change is constantly under control through our regular contact with clients. We pretend that it goes a little bit deeper than that as well. Our claims management automatically improves the efficiencies of partner insurers' claims departments, as we're always on top of outstanding claims, with meaningful strategies to drive them quickly to settlement. In our experience, reactive and uncommitted claims handling simply labours on costs. Regular and smart contact with clients means we can become an integral and important part of their business all year round. We don't have to learn all over again what they do, how they do it, and the risks and threats they face. The three parts of a risk manager are risk and threat identification, prevention and management, and elimination of waste and inefficiencies, creation of valuable, robust and sustainable risk transfer strategies, and then balance sheet protection and the event of a significant loss, enabling the client to recover their pre-loss position. So, if I just move on to a technical update now, because this is a really relevant part in terms of how future insurance premiums are going to be calculated. The discount rate was reviewed in March. Now, what is it? Compensation awards are designed to put a claimant in the same financial position had they not been injured. The award is based on future losses which are likely to consist mainly of loss of earnings and the cost of care. It is designed to ensure claimants are not under or overcompensated. The courts apply a calculation called the discount rate. This adjusts the personal injury damage award to take into account the return expected over time when a compensation lump sum is invested. The rate is set at a level to reflect the return available on the lowest risk investments, typically index-linked gilts, the value of which has been falling since the financial crash in 2008. So from March 2017, the discount rate changed from 2.5% to minus 0.75%. This is now being put under review, but is likely to remain as it is until probably Q3 2018. In monetary terms, for example, a claimant suffering life-changing injuries who could previously have been awarded 3 to 4 million would now receive 12 million under the new rate. This has serious repercussions as these claims will need to be funded in the future by insurers who are seeing a steep increase in their only reinsurance premiums, whilst also calling into question whether the current limits of indemnity being purchased are actually adequate. For example, under employer's liability, the majority of businesses only purchase £10 million worth of cover. We know of one business, which isn't a Jelf client, I should add, where a reserve claim awaiting settlement has grown from 3 million to 13 million, leaving the business to find the £3 million shortfall. So why is claims management so important? Now, underwriting is much more complicated than boiling it down to a simple equation, and we do have some underwriters in from QBE, so I will sort of say it's much more complicated than this. But we try and boil it down to if you can take £1 off your claim experience, then you're probably going to save £1.50 in future insurance premiums by removing attritional losses. This equation is basically to demonstrate to a prospective client, the direct financial link between claims costs and premium expenditure, and therefore to control or reduce premiums, they have to control and reduce claims. In addition, the 3-year average claims cost, insurers must allow for additional cost of carrying your risks. Reinsurance costs, for example, Large losses, depending on the underwriter, say, for example, above £1 million, will be reinsured, and typically this would probably represent 10% of your annual premium spend. They need to allow for claims handling costs. They need to pay for your claims to be administered and settled. Policy issue costs, surveys, loss adjusters, and of course, like any other business, insurers would like to make some profit. So the smart way to save premium, which now attracts 12% insurance premium tax, we should add, is to stop funding the claims management companies, fraudulent claimants, credit hires, spurious personal injury claims. We want to plug the bottom of the bucket to reduce premium spend, and we want to help our clients do this by putting in place robust pre- and post-loss claim systems. The claims farming culture to our industry is what part one Tyre is to yours. So how can we make a difference? Well, it's the management of our clients' claims which delivers the wins for all our clients and insurers alike. It is vital that we understand how this management is applied. It's not simply taking a heightened interest in our clients' claims. All of our services are in one way or another dedicated to the prevention or mitigation of all forms of loss faced by our clients, whether insured or not. We're trying to demonstrate how the external risk management system creates cradle-to-grave management of all losses, and as the inherent disciplines come together to consistently battle against the waste and inefficiency created by loss, and in the case of motor, practically a battle against a slick and pervasive claims farming industry. As we also implement very effective pre-loss systems, perhaps this should be conception to grave management. For clients with recurring loss, particularly motor fleet and liability claims, we carry out quarterly claims reviews, which allows us to drag individual claims away from the usual paper chase exercises. This is extremely important. It allows us to address many of the common complaints aimed at insurance brokers and by default insurers, which clients have, which is essentially withholding information, inflated reserves which are sitting on a claim experience driving premium, no opportunity for input or to challenge defensive third-party claims, claims settled without client's agreement or knowledge. So at this point I'd like to introduce Rod Watson to you. Rod is a claims executive and is absolutely pivotal to our success in the industry and undertakes the claims reviews with our clients. Rod will give you a bit more insight to the marginal gains he achieves for clients, turning those £1 back into £1.50s.
I'm Rod Watson, a claims control executive for Jelf. I've been with the company for 9 years and 27 years in the insurance industry. I work with my clients to manage their claims through regular reviews, as Ben says, and also by trying to introduce some risk management techniques which might also drive those £1.50s down. In terms of the claims reviews, I don't just put a spreadsheet in front of you and say, there's your claims. Unlucky, isn't it? We look at why those accidents have happened, what the drivers for them were, and what we can do to prevent or manage those losses. The important thing for you to know when you're paying your insurance premiums is where is your money going. It's a very hard market, and premiums are on the increase. You have a right to know where that money's going. One of the drivers for increasing premiums the driver for increasing premiums is, of course, claims. Now, I'm sure you've had experiences of occasions where you've been really annoyed that an insurer's made an excessive claims payment. Do you know what the reason for that is? You may not. It's my job to tell you why that's happened and what we can do to stop it happening again. I certainly get annoyed by claims payments that are made. If we refer that for a moment as claims leakage, how can we stop that leakage? One of the most important factors is incident reporting. Not just the timing of it, but the quality of it as well. Insurers have bucket loads of data. They've conducted extensive actuarial inquiries and found that there's a direct correlation between accident reporting times and claims payments. It's a well-known fact. So we look to try and streamline working with you, the best way of getting claims reported as quickly as possible. And not just the timing of the report, but the quality of the report as well. Insurers do do make payments sometimes because they just haven't got the information and the evidence available to defend a claim. We have to help them with that. We want to work with you to help them to do that. If insurers can get hold of the claim quickly and they've got the information that they need, they can intervene and they can control that claim rather than a lawyer or an accident management company doing that for the claimant, because we all know what happens when that happens. So quality information and evidence is crucial. We will help you introduce procedures and systems into your organisation by educating your staff and your drivers and anybody else that's involved in the process to get to that point. So if we look at risk management claims leakage, so insurers are provided with poor information, too late, the claims are presented, it's basically, well, get your checkbook out, you haven't got any control over it, and that's what I'm referring to by claims leakage. So that impacts on those £1.50s, and it's how we can improve that. We want you to be able to fight the right claims, to defend claims where it's just and right to do so, but we also don't want you to fight lost causes, because the only winners then, and again, are the accident management companies and the solicitors that are behind those claims. So if it's right to admit liability, but are you in a position where you know that it's right to do that? We will help you in making those decisions and making sure that the insurers acting on the information that we provide and they implement good quality claims handling, which results in the payments that they ultimately make, which drives your premiums. It all comes round in a big circle. So, well, there's claim. Sorry about that. I can carry on for a moment anyway. The next slide was basically about risk management, and it breaks down what risk management is. It's identification, analysis and control. So, as your broker, we don't just look at what happened in an accident. Of course, when an accident's happened, we do that. We want to know what's happened and we want to get information across to insurers, etc. All things we talked about. But if we don't learn from our mistakes, it'll happen again, and it does keep happening again. So it's important in the identification and analysis to look at not just the what happened, but the why it happened, when it happened, where it happened, and how. And what could you have done to prevent that loss, stop it happening again? Or when it's happened, we'll look at methods that we can put in place to minimise that loss. Was the accident avoidable? What was the root cause of the accident? What do I mean by root cause? Well, for example, take a motor accident where one of your drivers has hit somebody in the rear. We all know what happened, we all know why he did it, but do we really know the root cause of it? That driver, for example, was pulled into the back of a third party, leaving a roundabout. It's a classic scenario. He thinks the third party's gone, he hasn't stopped in time. Okay, but what made him do that? Why did he take his eye off the road? Well, through a post-accident interview process, you might find out that actually he's driven quite a lot of miles that week. He might have driven a couple of thousand miles. And when you get under the skin of it, he's absolutely knackered. He's got some problems at home, his wife's poorly, his dad's poorly, his kids are playing him up. And you might think, this guy's a risk. But you need to understand and identify that to be able to do something about it. Other things such as how the effects of an accident can be limited. So, your driver comes in and says, I've hit a parked car. And what's the classic? Didn't cause any damage, just a scratch. Insurers get the bill in, and then there's the credit hire on top of it. All of a sudden that scratch that you think is £100 is actually a few grand. Well, if it's to take some photographs at the scene of the accident, you might have been able to actually argue that claim, defend it, and your insurers might have actually gone and repaired that vehicle before anybody else got hold of it. So this is what we're talking about in terms of bringing in systems and procedures that help you manage your risk. There are other areas where we'll look at behaviour. we like to try and influence behaviour wherever we can, working with you, such as disciplinary procedures, how to manage post-accident interviews, and we'll look at practical, feasible and appropriate solutions, cost-effective solutions, whether it be in-vehicle technology or less subtle, cheaper techniques to be able to manage your risk and make sure that you drive those premiums down and you're an attractive risk for insurers to look at. If you look after the risk management side of things, the price of your insurance policy will to some degree look after itself. If you're the type of client that's running around every year searching the market for the best price, and there's nothing wrong with that, that's what we're here to do as a broker, it's not the best approach. What you really want to be doing is be comfortable at the end of the year that your claims are at the right level and your insurers understand what you are doing to manage your risk. For that insurer to be able to say, I want to be competitive on pricing your policy because I want your business, rather than look at that claims experience. I don't want that. Pass you back to bed.
So, the moment of truth in the broking part, ultimately our job is to ensure that the cost of risk and loss to a business is as low as possible. And transferring risk from the client to the insurance market is a key strategic tool. Essentially, risk transfer is done through negotiation, discussion, and demand selling skills to get the best and most valuable price. Reference to value is important. We have had to add value to our clients' businesses. As stated previously, the risk manager must protect the balance sheet of the business. All the work that we do leads to the transfer process. Loss reduction techniques, risk management strategies, meaningful data collection, to ensure that the people the risk is being transferred to, i.e. the insurer, fully understand what they are accepting, can provide clear and valuable protection, and can price risk at appropriate levels. What does work against the efficient transfer of risk is out of control losses, as Rod said, an inability to control, manage and reduce risk, and inaccurate or non-existent loss data. Without these, insurance program costs cannot possibly be known to be valuable. So when insurance market conditions are largely irrelevant, for example when the commodity price of insurance is low, which we call in the industry a soft market, there is a massive danger that punitive claims management will derail a business in the event of a catastrophic loss. And it can also take the attention of business away from everyday loss control, as the consequences are not so acute. In a soft market, clients may well see the cost of risk transfer reduce, regardless of whether they adopt or have any loss control and risk management in place or not. But when insurance markets do harden, as they are following the discount rate change and the catastrophes in North America, businesses that have not controlled risk and loss and have not collected good quality data are severely exposed to the worst ravages of tough conditions. We must act at all times as if the transfer of risk is going to be difficult and prepare ourselves and our clients for the worst. The later we do this, the worse the impact, as the control really needs to be exerted for a period of ideally at least 3 years, because that's what insurers rate on, is your 3 years of claim experience. So doing it on the eve of market conditions is going to be as reactive as not doing it at all. By practicing these techniques, our clients have options in all market conditions, and it is much safer and easier to retain risk, which is a classic example to higher insurance costs, when you have the management information available to do so. We can, by doing the things we have illustrated, put our clients in a great negotiating position with insurers, which is of high value in soft market conditions and essential when the market is difficult. It's this mindset, continually preparing clients for the onset of hard insurance market conditions, which makes us stand out. And as difficult conditions return, they will be prepared for them. From the insurer's perspective, having a comprehensive and detailed understanding of the risk and the comfort that we are actively and continually managing that risk with the client enables the insurer to underwrite and rate effectively and comparatively, thus maximising chances of retaining business over a longer period of time. The next one's quite a busy slide, so I'll go say that one. During the break, we were talking to clients that were saying about the technology that's been presented this morning and throughout this afternoon, and how it was sort of quite frightening, really, the pace of the changes and our business is no different. I think over the next 10 years we're going to see unprecedented change and uncertainty. And believe it or not, these changes don't just happen at your insurance renewal date. So by doing the quarterly reviews, keeping on top of things, I think that's a great way to manage change in business. So from GDPR, cyber recovery insurance policies, reputational risk, increasing regulation from the environmental agencies, and Peter, I had got a slide on the environmental agencies, but it didn't make its way through compliance. And HSE, to name just a few, we believe that insurance can play a real part. Thank you for listening.
Well, I do apologise. We haven't insured for theft of a projector, unfortunately, but we will get sorted in the break.